Let's welcome on board Mahendra Jajoo and figure out exactly that. Mahendra, hi, good morning. Good to have you on the show. Uh, Mahendra, what is it that the market's been anticipating when it comes to both the bond as the currency market with regards to Jackson Hole? Because it seems like it was, kind of expected that come September and we would see US easing rates. But again, there's only a hint of that, and it seems like it's going to be a tall order still.
Yeah, I think Jerome Powell pretty much indicated that there would be a space for a rate cut in the coming months. And while he is still suggesting a bit of a struggle between rising inflation and rising unemployment, I think the balance of the policy is still shifting towards a rate cut. But in my view, because the central bank does not seem to be very confident, and they are still concerning, I mean, raising a lot of concerns on, inflation and other macro variables. The rate cut will not convince the market to bring the yield curve, down significantly. And therefore, I think this would be a rate cut which will possibly not have much of an impact at the long end of the curve, because the market's concerned about the supply, about the upward trajectory of inflation, etc., will not be dealt with confidence from the central bank.
Right, okay. Mahendra, also help us understand what the difference between the yield spread between Indian bonds and the US bonds are. Because when we were cutting, they were at a pause, and now when they are expected to cut, as of now, for the time being, we are at a pause when it comes to rate cuts. How does that pan out for the spread between India and US bonds?
I think the spread between Indian bonds and the US bonds, as you mentioned, have narrowed significantly. And there was a point when they were below 200. Now they are at about 200, 200 or just below that. That has been the anchor around which the bond spreads have stabilized. There is a lot of concern that the spreads are too low, and that is, I think, precisely the reason that, in spite of the rate cut by the Reserve Bank, most of the focus of the Reserve Bank has been on the transmission of the policy at the shorter end of the curve. And the longer end of the curve, we have seen the yield curve steepen in India, and therefore the spreads have been stable. I think Indian macro fundamentals are very strong. Our inflation is at you know decadal low, whereas the US inflation is very sticky. We don't have a challenge with the government bond supply because of the government borrowing, whereas in US you have a challenge both in on account of higher supply, and secondly on account of reduced demand from, because the global central banks and other investors are buying less and less of the government bonds. So that spread at one point looked to be narrowing further, but at this point, given the external worries on account of tariff, etc., is pretty stable. I'm not worried about the spread, being unsustainable, but obviously there is very little room for the spreads to narrow further, and therefore I think this is the new normal that we will see for some time, maybe 25 basis points uh, around this current level.
But do you sense that there could be further pressure on the dollar, Mahendra, and thereby impacting rupee as well?
See, rupee is already at all-time low, and this has happened in spite of the dollar index itself coming down significantly. So I think the Indian currency has been affected because of the lack of the FPI interest. We have seen sustained the selling from the FPIs in the capital markets, more so on the equity side, and then our capital account balance has also been affected because the net FDI flows have shrunk meaningfully, while the gross FDI flow is very good. There is incrementally equal amount of outflow on account of FDI, more on account of the Indian companies investing in overseas markets, and on account of remittances from the foreign investors by way of dividend and other payouts. So, therefore, on the balance, I think rupee has found a fair value. We have seen the rupee over at around this level, and any good or bad news has not been able to take the rupee in a particular direction in a sustained way. So I think rupee is finding a very firm hold at current levels, and I think from here on, I would expect the rupee to appreciate more probability than possibly depreciate from here in the next 6 months. Given the fact that the dollar index is continuing to depreciate and the rupee is already at all-time low.
Makes sense. Okay, Mahendra, great to have you on the show. Thank you so much for your time today.
Thank you so much.